It's a lot simpler to talk about what's happened on the farm this month. Rain, no rain, crops look good, crops don't look good. Somebody's farm down the road sold for X amount of dollars. But what if you want a longer term look at what's happening? Matt Erickson wanted that, so he is part of a project that did that. Hi, I'm Dave Price. Matt is an ag economist with Terrain Ag. He's also a family farmer near Lafayette, Indiana. So he has more than just a researcher's curiosity into what's happening on the farms. This week, he takes us into what is called How Midwest Cropland Earns Its Returns. It's a 3-decade-long look into volatility, appreciation, and what makes one region of the country different from another. Hey, Matt, welcome. Thanks for joining us. How are you?
Good. Thanks for having me on and happy summer.
Happy summer. As we record this, we are both fortunate that we are each indoors
Very
because
much.
we are both going through, as you termed this, the heat dome, which is great because it's a great time to melt off the winter weight we put on.
Yeah, that's true. Air conditioners are hopefully working, crops are hopefully growing,
Amen.
and yeah, 4-H fair season is right here around the corner.
Outstanding. Hey, I'm gonna start off with a quote of yours because I think this really sets up this conversation. All right, so give me a little space here because it's a couple lines long. This is from your report with Terrain that I really want to get into in this episode. All right, here we go. The consistent gap between nominal and real performance, approximately 5.5 percentage points per year, underscores that a substantial portion of long run nominal land returns reflected inflation flowing through rents, revenue expectations, and land values rather than outright real wealth creation. I saw that in your report and I thought, man, that is like the synopsis of everything, right? And sort of like stepping back from this, you put together this report that is a lot meatier in totality here. And I feel like our society right now, it's all quick hit stuff. And you look at the stock market and you react, or we bomb Iran and you react, and all these things are significant. But before we get into the crux of that long quote there, I wonder if you can explain why you put this report together the way you did to look at such a long period of time.
Yeah, that's a great question, and thanks for the readout and the compliments to that. You know what? Every day I work with farm credit customers that we serve, and one of the things that when I interacted with them, right now farmland is getting a lot of attention, and rightfully so. I mean, it makes up about 80% or close to 80% of assets on the balance sheet. And I think what customers were looking for was just a simple report that looked at how has farmland performed over the past 30 to 35 years when we think about the ag cycles and the business cycles that we've gone through. And what I've done is basically I've taken a kind of a 10 state territory across the Midwest and the plains, and I've looked at kind of farmland returns, total returns during that time period. And when we think about this from an elementary level, and again, farmland's very complex. Again, it's hyper local. We all understand that. We probably have a conversation around that. But farmland returns really come from two sources. First is the cash income side, and the other side is the land appreciation side. And so I wanted to take a look at those two return kind of components, but also I think oftentimes when we think about a farmland purchase, we think about the economics of farm ground. We also have to include the volatility and the nature of volatility for that asset. And so that this report hopefully kind of gleans some information with regard to those three components and how they've performed over the past 30 to 35 years.
I have, as I was kind of reflecting after I read this report, I was thinking about some good friends of mine, husband and wife, and their two boys are now grown, but the wife's grandparents toiled on the farm forever,
Hmm.
squeaked by, and nobody wanted to. After he died first, Grandpa died first, then Grandma died, And some years went by, they rented it out for a while, and then eventually the grandkids decided nobody really wanted to take this over, so they sold it, right?
Yeah.
And it was so illustrative to me about grandma and grandpa died without like a lot of money, right?
Hmm.
But the grandkids, because of what grandma and grandpa were willing to do for 50 plus years, inherited a substantial amount of money. And it's such an altruistic gesture, really. But I
Yeah.
felt like it sort of summed up when you talk about land appreciation that, the land was obviously where grandma and grandpa's wealth was. And they worked so hard for so many decades to put that together, and then nobody in the family wanted to keep it going, so they sold it. Grandkids who really didn't have a lot of time on the farm ended up walking away with a lot of money. And I thought, gosh, man, what a loving gesture, but it also just sort of underscored how hard those folks worked and didn't have a bank account that reflected that. You know what I mean?
Yeah. Yeah. Absolutely.
Okay, so sorry for the sidebar there.
No.
Because of the way you've sectioned this out, now you've also gone into the difference in regions and states, but this really underscores the value of if you have a farm operation, especially if you're in the right state, that is an income generator,
Yeah.
you're a lot healthier for a variety of reasons.
Yeah, and I think that's what the report kind of looked at. What was interesting is when I kind of dove into the numbers, and I utilized USDA's data set, which gives me kind of a longer term time series. And again, I think, whichever data set, I think the biggest thing for farm ground is finding that consistent long run time series that an analyst can use. But I think when I look at kind of that 30 to 35 year time period, a lot of these Eastern Corn Belt states, such as Illinois, Indiana,
Mhm.
Ohio, as well as Iowa. Iowa's probably here in the middle, but a lot of those states really relied heavily on the appreciation side of things with regard to where they gained the most return,
Mhm.
with regard to that 30 to 35 year average. But then I look at some of the Western Corn Belt states, and again, you think about the ag cycles, different policies that have kind of come about during that time period, dating back to the 1990s. And Kansas and South Dakota, and even Nebraska, generated a lot of their total return, at least on the income side. And what's interesting is, when we look at the Eastern Corn Belt, oftentimes the volatility is much less. It's more of, I don't want to say a safer asset, but the volatility is much lower. You look at the Western Corn Belt side, where you can gain a little bit more return when you adjust it for inflation on the income side, but the volatility is much more wider with regard to the gains and even the losses that can be associated with it.
Okay, so look at those Eastern Corn Belt states first. You mentioned about the lesser volatility there. Why is that?
I think, one, you've got to go back to, in my mind, I think first we got to think about policy in general. And I think when you think about, the ethanol boom that occurred during the kind of that '05 when we were starting to
Hmm.
put together, or build ethanol plants, things of that nature. I think with regard to yield wise, I think there's some consistency with regard to corn and soybean mixes have been relatively kind of standard within those regions. You get to Iowa. I think when I think about Iowa, I think it's more fluctuated with regard to, let's say, buyer optimism. It could really kind of swing a little bit too with regard to how the cycle generates as well. But then I look at some of these Western Corn Belt states with regard to South Dakota, Nebraska, and Kansas. And I think a lot of that also deals with the crop mix with regard to, some of those states may have been more wheat based, but
Hmm.
then as ethanol and that ethanol kind of policy is kind of generated, they've become more standard corn and soybean states. And so I think there's a lot of reasons why, this is kind of occurring, but I think, it's more along the lines of one, I think we're just getting more buyer demand in those areas. And I think that helps the appreciation as well as even the cash income side of this.
Man, I would love to be able to sit inside your brain sometimes because when I was looking through your bio, you've spent some time in DC. I mean, you were with USDA too, of course, but You've spent time as a staffer on a U.S. Senate committee, so you understand, and by education and everything, you're an economist, so you already know that side of it.
Yep.
Are you fifth generation, right?
Fifth generation.
Fifth
Yep.
generation. All right, so you know that you've got the legit street cred of being a farmer, and it goes back in your bloodline a million years. So you've got that aspect of it. You understand policy and politics from the time in DC too. So as you're watching these policies either get developed or stall in Congress right now, as we talk, the Senate has not figured out the farm bill. What are you thinking? Like, is our
Yeah.
problem that we don't have enough members of Congress who have that kind of hands-on real experience on the farm, so they don't get it, so they kind of do a one size fits all policy too much where it's too generic? Like, what's our weakness with this?
Yeah, that's a great question. And I would say, this is kind of coming from my former, world in terms of being in DC. There's not many farm kids or quote unquote farm kids
Hmm.
that, well, I should say farming is a very small kind of niche in Washington, D.C. And you look at the members of Congress, administration, things of that nature, and you have seen a trend with regard to less members of Congress, having that occupation as a farmer. But Dave, that this is the reason why advocacy is so important. And that's the reason why agriculture needs firm representation in Washington, D.C., because what we do know about agriculture and what we do know about farming is I thought your opening remarks were just spot on. Farming is we're very rich in assets, but we're poor on cash, right? And so I think that nature with regard to agriculture, that's an important component for folks when we think about advocacy. We also think about, how this can tie back to, farm ground. As a farmer, as an owner operator here in Northwest Indiana, purchasing a piece of farm ground is really easy to do when appreciation is really kind of skyrocketing and it's
Yeah,
a really easy investment.
sure.
But I think where the test comes in is when we have margin compression, the ag cycle kind of turns. And again, we are in a very cyclical, business here in agriculture. It still will be, and it always has been. And so I think, the advocacy in terms of those times when things are good, but also when things are not so good, are important to educate. Because again, when I worked on farm policy in DC, a farm safety net should never be advocated when times are bad. They should be
Hmm.
advocated when times are good because we need to prepare for that policy when those times are bad. And so again, I do think having that reliable advocacy, making sure that we have folks that are farmers, boots on the ground, going up to Capitol Hill and telling their story is really important.
So how do people make sure that happens? Because you have a lot of politicians who are reactionary. They're not for all we need to do is look at our federal debt right now, which is insane. It's approaching $40 trillion, which is some mind-boggling number that you just can't process it. Social Security is all jacked up. They
Yeah.
know what the warnings are about that, but they're like, we're not really going to touch that this year, and it's an election year, whatever. I feel like farm policies is the same way, right? They're going to do most likely, not to be a cynic, but they're probably going to do what is politically expedient for this year. You would hope they do a farm bill after failing to do it for 3 straight years, whatever it is. But like, how do how is that demand going to happen? How do these advocates make sure that these folks are more longer term in thinking?
Yeah, and another great question there. And I think with regard to the message to Capitol Hill, I think it's just really simple. And policy is a very you've got to get politics can be a kind of a convoluted type of industry and a profession. But when producers have to put a crop in the ground, producers are long that crop, meaning that once you put that crop in the ground and it starts to grow, well, I mean, you're kind of beholden to Mother Nature,
Sure.
weather, and performance there. But what producers need, and again, it sounds so simple, but it can be complicated. They need certainty and predictability. And with regard to making sure that they have the risk management, policies in place, whether it be, tax policies, things of that nature, making sure that there's the certainty and predictability and risk management for producers to just do their job and be protected against, things that they can't control, like Mother Nature. So I think all those things with regard to, getting a farm bill across the finish line, again, I'm an optimism, by nature, and so I think there's cautious optimism that this thing can just get, done and across
Yeah.
the finish line. But again, I think what producers just really need is that certainty and predictability to get those risk management tools in place, go back to their operations, and do the jobs, that they've always done.
So the most immediate side, does that have to be on input? Have to do something with input costs if there's some way to bring those down quickly? I don't know how that would happen, but is that where the pressure point can get released a little?
Well, I think from a producer standpoint, I think from fixed, what I think we're going to see this year is I think we're going to see the true return to management that producers are going through for 2026. And what I mean by that is, Dave, when I go visit my farm credit customers, across the Midwest, one of the things that I harp on, and I sound like a broken record because, again, I'm not a lender, I'm an economist,
Yeah.
but I always tell producers that, one, know your numbers through and through. And why that's important is because, one, if you know your numbers, then, by default, then hopefully you know what your break even is. And if you know your break even, you can stress test those levels between price and yield and kind of fluctuate with regard to, okay, if I know that I have to, let's say hypothetically, break even at a $4.90 to $5 corn price, maybe in this environment where we've got the US and Iran war situation, we've got a tight global corn crop, I think the lowest since 2013, 2014 in terms of ending stocks of corn, then maybe I can capture some of that upside when the market tells me to capture it. And so again, I think, those producers that are able to capture some of that, upside volatility in terms of price, again, you're still going to have margin compression, but again, who doesn't want a higher price when the opportunity is there? So I think, knowing your books, knowing your cash flows, knowing all those things, but then advocating in terms of making sure that risk management policies are in place, all those things together, I think are extremely important.
Not to test your optimism, but we've seen this report about especially input costs in Brazil. If farmers there have such an inherent advantage, and if they don't frankly care as much, they're going to plow down the rainforest, they'll knock out anything they want there and not be concerned about the environment to try to crank out whatever they can and maybe have growing season advantages in some cases, whatever it is. Like, how is that not a long-term problem for us?
Yeah, I thought it was an excellent report, and I think when you look at that, kind of competitive, who has the competitive advantage between both countries, the US and Brazil, I do think that that does become a problem, but also too, from a management standpoint, making sure that, one, again, I just go back to knowing your break even, knowing your numbers, and farmers can do only so much, right? One other item I think where we think about this portion of the ag cycle and going through margin compression, I think one, and it's really kind of tough to do with regard to some of these numbers, but understanding and kind of managing your fixed costs. And I think when I look at one of the fixed costs with regard to, let's say, land, obviously cash rent comes to mind. And I'll just play farmer here. If there's a magic bullet in terms of a negotiating strategy where I can get a lower cash rent, tell me, Dave. I'm all ears.
Yeah.
But I do think when we think about the nature of cash rents, those just remain sticky. And yeah, there is some sort of relationship with regard to farm incomes there. But again, when I think of cash rents versus land values in general, I view the cash rent conversation as a different bucket. And the reason being is because one year of lower profitability is not going to tell a landowner that I should reduce my cash rent. In my mind, it's got to be year 2, year 3, and you've got more margin compression in the system where you might see a slight reduction of cash rents. But the bigger, deal for me is, and why land values and land markets are so local, but also hyper local, is the fact that one, if you've got marginal bidder strength still within the local economy, you're still going to have strong cash rents,
Hmm.
right? And so if there's a buyer that's willing to say, you know what, if I'm paying 350 and that's too expensive for me, but then my neighbor says I want to pay 375, there you go.
Yeah. Okay, but in this Rural Economist report, you have looked at a scenario where cash rents could decline in 27, right?
Well, not in this report. This report just looked at the two kind of main returns with regard to farmland and how they performed, and then
Okay.
looking at the portfolio difference there. But on the cash rent side, this is more of kind of the trends that I've seen here, just kind of historically and everything like that. But I think where this environment is also different is I look at outside and I'm here on our farm in Northwest Indiana, and I see windmills. There's solar
Hmm.
panels that are, being, built and already built. You've got, I mean, data centers are certainly a big topic here in Indiana.
Hmm.
You've got, I mean, all this renewable energy data center, kind of development, as well as, bidding for high quality farm ground. All of those demand factors there, kind of help land prices stay relatively stable and
Sure.
not, and kind of maybe strengthen here a little bit.
Okay, but as you look in your report, you've talked about if land prices are not appreciating like they had been. Do you see this as, your crystal ball here? Is this a longer term trend? And how does that impact the whole thing where some states have been more dependent on the appreciation side of it?
Yeah, I think it's a couple things on that, Dave. And I think that really boils down to the question in the report. If I had a producer tell me, over the past 30 to 35 years, is this the expectation? And I would be very cognizant of that because one, I just wanted to look at the deterministic side over the past 30, 35 years. And why this is important here is because one, if we're thinking about what's occurred over the past decade or so, what have the economics told us here with this? One, it's we've had historically low interest rates over the past decade. I
Hmm.
mean, the Fed funds rate was between 0.25%. Most throughout that time period. You had, really strong farm incomes, oftentimes during that time period. You had strong ad hoc government assistance program, payments there. You also, during that time period, had rapid land appreciation during that time frame. So, one, I don't think what we've experienced over the past 10 years should be the norm when we think about purchasing that farmland here over the next whatever, how many years. And so I think the variables that I watch with regard to tracking, whether or not to purchase that piece of farm ground, obviously commodity prices, being one, farm profitability being another, interest rate environment. I mean, we could have a conversation on where interest rates are going.
Hmm.
I look at, here, Mr. Warsh, Fed Chairman Warsh, has been very upfront by saying prices are too high. We've
Hmm.
got to do something with regard to the price stability side of the dual mandate. So again, I think interest rates will play a portion of this. And so a lot of these broader economic conditions remain at the forefront. So, Dave, I bring this up because one, why is this important? Because one, I don't think this changes anything with regard to how farmers should view the opportunity to purchase a piece of farm ground. Because one, I do think a piece of farm ground has to be evaluated on two things. One is the cash flow potential, and the second portion is the appreciation potential for that farm ground. So I don't think those two change in terms of investing in the asset or purchasing the asset. But again, all these economic factors I do think play a role with regard to how farmland is going to be, thought about here over the next 10 to 30 years.
Man, you talked about Kevin Warsh. That to me is its own little docudrama. We watched how President Trump feuded with Powell when Powell headed the Fed, and Trump tried to essentially get rid of him and pressure him out and all this kind of investigate him, all kinds of stuff. And at the end of the day, the president, as a longtime real estate guy, is fixated on interest rates. And he's like, you got to move these things down, right? despite what,
Yeah.
your world economists are like, well, that's probably not the right move. So Powell's term ends, brings in Warsh, but there's no like Warsh is not out there saying, all right, we're bringing these suckers down right away, right? I mean, because
Yeah.
he knows the dynamics, he knows the markets would probably crash if he made big moves like that. How do you see that playing out?
Yeah.
I mean, the factors are not there to lower the rates anytime soon, it would appear, right?
Yeah, I think, and Dave, I'm going to be a little joke here, but I want us to take a walk down memory lane just 7 months ago. I
Okay.
mean, we were talking 7 months ago that we were talking what 3 to 4 interest rate cuts
Yeah.
as we begun 2026,
Hmm.
and then all of a sudden we had this thing called the U.S.-Iran war, and we had energy prices, kind of spike up because
Yes.
the strait was closed. And anytime when you've got 20% of the global, oil market, kind of shut down and not being able to be dispersed in the global market, you got a problem with regard to higher oil prices. So now, today, we're mid-July, we're in the summer months, and now we're talking about, interest rate hikes.
Hmm.
Here maybe one or two here for 2026, and then whatever 2027 brings about. So I say that because one, the commodity environment's volatile, but also the interest rate environment is also volatile. And you think about, and we'll get to, Chairman Powell here in a minute, but you think about my time when I was in DC, and, that was part of that time when I worked for Chairman Pat Roberts on the Ag Committee. President Trump was there for his first administration. But think about the different macro environment that
Hmm.
was there during that time. I mean, you had interest rates between 0 and 0.25%. So
Yeah.
really inflation, yeah, inflation was a concern when the Trump tax cuts were passed during the first go around, but it really wasn't like what it was today.
Hmm.
So we had a historically low interest rate environment. Trump 2.0, when we go through this administration right now, we've got interest rates, what, between 3.25, or no, excuse me, 3.5, 3.75, borrowing, prime rates about 6.5, 6.75. Things are just, higher with regard to
Yeah.
interest rates. So I do think the bond market here, especially the 10-year, is one that I think this administration pays attention to relatively closely, but also the land market pays attention to it pretty closely as well.
For sure. Hey, can I back you up on Kansas and South Dakota? And I should have followed up earlier, but the relative health of those states and the income potential of those states. Can you dig in a little bit? Is it the diversity that has done so well there? And you mentioned maybe slightly to a lesser degree Nebraska, and I think Missouri in some ways too in this report too, right? But those maybe the Kansas and South Dakota and then Nebraska in particular, like what's their strength? Can you dig into that a little bit?
Yeah, with regard to farm income, I think it boils down to, and I've heard this saying before, it comes down to plows versus pastures.
Hmm.
And, one, at least on the row crop side of things, yeah, significant margin compression without a doubt. And I know, some of the Western Corn Belt, if you look at the drought monitor, there's some significant drought pressures
Sure.
out west, well, west of where I live. And so, but I do think you have a couple things with regard to, cattle prices are still remaining strong. I mean, if you look at the difference in, I don't have the numbers in front of me, but crop ground versus pasture ground. Pasture ground, I think is really being supported by, a healthy cattle market, cattle prices, things of that nature. So I do think, when you look at the farm income side of things, yes, margin compression, is occurring on the row crop side, but the livestock side of things looks relatively healthy with regard to where those folks stand. So I think you've got kind of a mix or a split between, crops versus livestock in those states.
Okay, so what helps those other states as they look ahead? If I'm in one of those states, where is my optimism? Because I've seen, relatively speaking, where I am income wise compared to these others that you just pointed out. So where's my hope that things are getting better here?
Other than South Dakota and
Hmm.
Kansas.
Hmm.
Yeah, I think, and we can go a couple sides to this. One, I think on the livestock side, and I always remind folks that this ag cycle really started with livestock, and in particular hogs.
Hmm.
And I'm a hog farmer here in Northwest Indiana, and 2023 was a relatively red year. I mean, profits were not good
Yeah.
during that time period. And so now, because we were feeding, hogs at higher feed costs, that's kind of adjusted here a little bit, and that downturn is kind of modified there a little bit. So, hog producers, while, hog prices have repriced, profitability still remains positive here with regard to hog producers. So it's not just cattle, but hog producers. There are some profits to be made out there in this current environment. I also think too, Dave, that and again, this is why it's so important for farmers to be vigilant with their marketing. Because one, I do think when you look at the row crop side of things, one, as I mentioned earlier, right now, again, we're in a heat dome across the Midwest. Now, some areas in the Eastern Corn Belt have received ample rain, and some areas, at least in Southern Indiana, have seen a little bit of flooding. But July and August tend to make a corn crop. And if you look right now at the corn balance sheet, one, USDA is still at 183. That's their trend line yield for 26-27. But you also look at what's really driving the corn balance sheet. And in my mind, it's exports. The demand side is really helping kind of drive that 2 billion bushel beginning stock that we had last year or last crop and kind of whittling that down. So for producers, we've got this heat environment. Moisture, who knows what moisture is going to bring, Mother Nature is going to bring.
Yeah.
But there could be opportunity there where if you do have a hot and dry July and August, you could see some fluctuation from USDA to lower yields with a demand environment where exports look relatively good. But also on the global side of things, the global ending stocks for corn is at its lowest level since 13 and 14. And so, again, I do think there could be some upside price opportunity here if things do play out with regard to at least some on the row crop side.
What are you watching for the rest of 2026?
Oh, a lot of things. One, I think in this environment, the one that I'm really curious about is first is on the macro side. And, when I give presentations, I don't portray myself as a macro economist. I'm an ag economist. But if you look at one of the things that we have to do now, and one of the things that could impact, us now and in the future is if we don't get the price stability side right with regard to inflation. Because one, inflation impacts our production costs. You look at, the things of with regard to we had a good inflation report here for June that came out earlier this week, but we're still not out of the woods. And in my earlier remarks, I was going to go back to Chairman Powell and his kind of time during the Fed. And I think we can glean a couple of things with regard to his tenure as Fed chairman. One, he navigated, the U.S. economy through a lot of things, right? There was COVID, there was this transitory environment. But yet, when we think about the dual mandate of the Fed and price stability and the target at 2%, inflation was still above 2% during that tenure. So now that's been kind of left over to Mr. Warsh to kind of figure out in his leadership. And so I do think, the price stability side of this impacts everything with regard to, the 10-year treasury, whether it be expected inflation over the next 10 years. You look at the term premium that the 10-year kind of looks at. And what I mean by the term premium is if I'm an investor and I put my capital over a 10-year time period, and if there's any uncertainty, I want my purchasing power to maintain kind of strength to hold that asset over that 10 years. So that term premium remains positive. We haven't seen that relatively over the past, decade when we had historically low interest rates. So I do think it impacts the 10-year borrowing costs, things of that nature, but it also impacts things like, transportation costs that may be implied with regard to input costs. So we've got to get the price stability side of this thing figured out in order for us to have stability in the U.S. economy.
You mentioned the June inflation report. The numbers are better, and it's primarily driven by the fact that energy prices went down, right? Yeah. I mean, that was such a huge factor. Not to oversimplify this, but the biggest immediate thing we could do right now is finding peace with Iran, ending this war, getting the oil flowing through the strait again. Doesn't that, because we've already seen energy prices climb back up some after this renewed fighting, and we're in as we talk, the 5th month of this or whatever. Is this oversimplified? Wouldn't that be the most immediate way that we can try to relieve some of this?
Yep, it's the most immediate way, but where I get concerned about this is one, how long does this war last?
Hmm.
And what I mean by that from an inflationary standpoint is, if energy prices, remain volatile and energy prices, let's say, climb, if this situation maintains or gets worse, oftentimes those energy components, such as, gasoline prices, diesel prices, trickle outside of just the category of energy
Yeah.
inflation. And so you look at services. Services are still remain sticky. Transportation services. Certainly one that comes to mind with regard to those type of services that are in that category. The one that again, I'm not an expert on by any stretch of the imagination, but medical expenses or medical services.
Hmm.
As the population gets older, the demand for those services will certainly still maintain kind of some stickiness there. So that's where I get concerned with this is, yes, the energy component will, it came down, but then how much has this spread across different kind of things like services, maybe food inflation, goods
Hmm.
inflation, things of that nature. Dave, where I look very carefully is, one, if we think about services in general, if I exclude food, I exclude energy inflation, and I exclude rent, sticky inflation still remains well above 2%.
Yeah.
And so I think that's the concern with inflation is it's kind of this invisible tax that basically gets put on consumers through the form of higher prices. And oftentimes a lot of these components remain sticky in the system where, again, you know, the one variable again, and I don't want to harp too much on this, but for us as consumers, one variable that I look at are consumer expectations a year out. And why that's important for us and why that's important for the Fed is because one, it's what we call a leading indicator in the system. So for instance, if as a consumer, you and I, Dave, if we expect prices to be higher a year out from now, what does our purchasing behavior do today? It increases, right?
Hmm.
If we expect higher prices down the road, then we're going to buy potentially more today, which will increase demand. So I think with regard to looking at that leading indicator, consumer expectations for inflation a year out from now still remain relatively elevated.
Matt, thanks for this conversation. Really appreciate the report. It's a deep read, but man, it goes into so many different factors, and I really think the value of it is it gives us that long-term, 3-decade perspective on all of this and the various factors that are a part of this. So while it may take you 2 cups of coffee to get through it, but man, there is so much substance there looking at all of these different factors. And thanks for this conversation as well. We really appreciate it.
Thanks, Dave. And one thing maybe to leave a note on is I think when we think about farmland and those decisions, I think it's important that farmland isn't just a single asset class. And what I mean by that is one, different states generate returns in different ways, right? Some regions might rely more on cash income, some regions may or states rely more on appreciation. Others, there's more volatility with regard to, different states. And so I think when we think about that as farmland as an asset, I think all those things have to be put together with regard to whether or not it makes sense for a farmer's operation. The last piece, Dave, I would leave off with is why this is so hyper local, at least, on the cash rent side is, yeah, there's marginal bidder strength, but also to each farm's different. And where I'm coming out with this is one, let's say for instance that, I'm over leveraged on my equipment costs. And, I've got, a new combine, and, basically I look at my own operation. I may need additional acres with regard to kind of, spreading that equipment cost over more acres. And so, one farmer may be that way. Another farmer may be a different way where that cash rent may be more expensive. But that's why farmland and cash rents are so unique because, again, it's not at the state level, it's not at the county level, it's at the hyper local level that we got to think about farm ground.
Well said. Matt, thanks very much. Appreciate it.
Thanks, Dave.
You can learn more about Matt, about terrain ag, and about how Midwest cropland earns its return just go to our breakout piece with Matt in the American Farmland Owner newsletter. It's the place where landowners get their news each week with the latest farmland trends, challenges, opportunities, and unique farm sales. You can check it out right now at AmericanFarmlandOwner.com. Thanks for joining us here on the podcast. We truly appreciate your support. Thanks for this conversation, and thanks for caring about the future of our farmland.